We've spoken together when we had been so lucky to have you on campus about the use of leverage, and in some cases you railed against it, in other cases maybe not. With low yields, it might be tempting to lever a portfolio. And of course, theory would say you can move along the capital market line either by adding capital structure to an investment, delevering, or levering it up. What's your view as a practical matter about the use of leverage today?
Well, after the global financial crisis of '08 was really a demonstration of the effect of leverage, because the world essentially had taken mainly mortgage-backed securities, but also loans to some extent, corporate loans, and put them into leveraged entities, structured leveraged entities, CLOs, CDOs, RMBS, and so forth. And so what they did is they had internal leverage, which is to say that you could buy a highly levered piece at the bottom of the structure with an extremely high levered return, or you could buy the top of the structure where you are not participating in the leverage with a low safe return over collateralized by the junior tranches. And what happened is that when you leverage, you say, well, if this happens, I'll be great. If that happens, I'll still be okay. If this happens, I'll probably make it through. And the outcome in terms of defaults on mortgages was a multiple of the worst case that anybody had modeled. And after the global financial crisis, I put out a memo that entitled "Leverage plus Volatility equals Dynamite." And there were thousands of defaults in mortgage-backed securities because of the over-leverage. And people should understand that leverage does not make any investments better. It magnifies the gains if you win and the losses if you lose. And so I think that to make an investment better, you have to increase what I call the asymmetry. The goal in active investing should be to look for asymmetry, situations where if things go well, you'll make a lot of money, and if things go poorly, you won't lose a lot. And if you can find those, that's the holy grail. If you find an investment where if things go well, you'll make 30%, and if things go poorly, you'll lose 30%, it's not a great thing. We're looking for this asymmetry, and leverage does not produce an asymmetry. It produces an absolute symmetry. It magnifies the gains if you win and the losses if you lose. But there's one other aspect which is not symmetrical, which is it reduces the likelihood that you can get through tough times. So if there's a downward fluctuation, an unlevered portfolio will make it through. A levered portfolio may not. So I think that leverage is far from a magic solution, and most of the real challenges in economic history have come from people who overestimated their ability to live through bad times with a levered structure.
So live by the sword, die by the sword.
Exactly. And in fact, if you think about it, leverage is an example, Chris. In investing, everything is a two-edged sword, except for alpha. If an individual really has alpha, which I define as superior skill and insight, that'll help you in good times and bad. But the other things in it, like leverage, like concentration, as opposed to diversification, these are two-edged swords. They help you if the outcomes are good, but they hurt you if the outcomes are bad.
Agreed. Since your memo, we've had some innovations. And one innovation was the announcement of, from two companies, Pfizer and BioNTech and Moderna, of an mNRA vaccine. And you hear in the news, people say it's never been used on humans. Well, it's been used on about 44,000 humans at this point. And also, there's been a corresponding shift in value versus growth. And for the purposes of our education at Wharton, the conversation about definitions of value in the memo I thought was poignant, because there's an ongoing question about whether intrinsic value really means something and how to calculate it. And so the coverage is great. What's your view about where we're going and the fact that what has been a medical challenge and a health challenge and a trade-off became an economic one, but now we have a potential cure, or at least a preventive measure,
a solution. We have a solution. And it looks like we'll get a lot more. And by the way, I understand that the FDA was prepared to give a vaccine emergency use permission if it was 50% effective, and these two are 90 and 94.5% effective. So this is a bonanza in terms of good outcomes. Look, I think it's always been assumed that we would get a vaccine and it would be effective, maybe not this effective. It's still going to take a long time before enough Americans are vaccinated to get the problem under control. And there remains a question of how many people ultimately will accept the vaccine. By the way, there have been vaccines which have been required. When I was a boy, smallpox inoculation was required. You didn't have a choice. But today we have personal rights, which sometimes supersede the rights of the community, and we have the anti-vaxxers and so forth. And then we have the logistical challenges of getting this vaccine to 330 million Americans, or if you need 660 doses to Americans, and keeping the Pfizer one at minus 70 degrees Fahrenheit and so forth. And just think about the number of inoculations that have to be made. If you have a center that can inoculate 1,000 people a day, which I think is a lot of vaccination, we need 330,000 center days to vaccinate everybody. Mm. It's an enormous challenge. I assume that sometime, my personal guess is, which is worthless, is that sometime in the third quarter we'll reach a level where the disease is really under control.
A critical point.
Yeah, critical mass.
And so the corresponding question then is, are you expecting an ongoing wave of bankruptcies in distressed sectors? And it's a bit of a forecast for fiscal stimulus, I suppose, but or do you think political winds will push the natural implication of the economic challenges away?
Well, look, what we have today, you made reference to it. We have a bifurcated market. We have companies whose business models were not challenged by the pandemic or were enhanced by the pandemic. Amazon and Netflix being obvious candidates for enhancement. And they are selling at high prices, and their stocks, and they are being lauded as having a brilliant future. And then we have companies and industries whose business models were challenged by the pandemic, and they, as you say, some of those stocks have languished, and they're still down for the year. But the question is, which ones are really hurt permanently, and which ones will the negative effect be temporary? Brick and mortar retail was doing badly before the pandemic, and the pandemic has accelerated the trends. And what will retailers be worth, what will shopping malls be worth, and so forth, is an open question. Other things, cruise lines, for example, you remember at the beginning of the pandemic, cruise ships were the petri dish for infection, and most people said, I'll never step foot on a cruise ship. But I think that once it's under control, I think that a lot of behavior will revert. So, we don't know what is the outlook for retail, for hospitality, for big city office buildings. But the person who gets that right will make a lot of money.
And how about your thoughts on, and then we're going to get to another student question, but how about your thoughts on the reversion of what we think of as value and growth? A week ago, Monday, we saw something like a 5 standard deviation reversal in the traditional index spreads in a single day.
Right. Well, growth investing, however defined, has outperformed value by a lot in recent years. And this is a normal issue. Sometimes the best securities do best, and sometimes the worst but cheapest ones do best. And I think, my personal definition of growth versus value is that growth stocks are valued on distant future potential, a lot of which is conceptual and unquantifiable. And value stocks are valued on current and close-in future earnings, in addition to hard asset values. Now, clearly, the growth stock aspects are what we would call speculative, and I don't use that in a pejorative sense, but conjectural, as opposed to the hard asset values and current cash flows of the value companies. And so I think that growth investing is a reflection of optimism in excess of what's applied to value stocks. And so growth stocks do great in good times, but are hurt in bad times. Value stocks, which are essentially cheaper on multiples, they don't reflect as much optimism with regard to the future. They get hurt less when optimism declines. So, for example, in 1999, I think that growth outperformed value by 2,500 basis points, and that was the most ever. But then in 2000, when the tech bubble collapsed, the air went out of the balloon of growth investing, and value did much better. And I think that, so I do tend to associate growth investing with optimism and value investing with less optimism. And I think that has a big effect on their relative performance. The other thing, though, is passive and indexation investing. Since there's been a very strong trend over the last 15, 20, 25 years to passive investing. And what that means is that there's nobody sitting in the office of the passive investment fund saying, well, is this a good company? What is the outlook? Does it merit the current price? You have a list of securities that for the passive vehicle, and when the money comes in, you buy them in the fixed proportions or proportionate to their relative market caps. And there's a self-fulfilling prophecy aspect to that, because, let's say, Chris, you and I agreed that over the next 5 years, every penny that went into the U.S. stock market would go into an S&P index fund. What does that mean? That means over those 5 years, the 500 stocks in the S&P would become massively expensive as they received all the cash flows. All the stocks in the market would become massively cheap because they were starved for capital. Nobody was buying them. And eventually, however, the non-S&P stocks would be so cheap relative to the S&P stocks that their outperformance would become compelling at some point. We just don't know where that inflection point is. And but I don't believe in permanent outperformance. I don't, if one asset class outperforms another for reasons other than the risk difference for a long period of time, eventually the outperformer will become so expensive that it can't keep outperforming. That's my belief. But as Lord Keynes said, the market can remain irrational longer than you can remain solvent.
Right. Another famous Howard Marks comment is being early is sometimes observationally equivalent to being wrong.
Right. Exactly.
Resilience is key. Good, Howard. Let's go to